Hello, this is Matthew Copley with Copley Financial Group, and today we're going to do a mid-month market update. I know we did one already recently, but there's been some new developments that we want to share with you that I think are going to have a huge impact on the markets and the economy. So we're going to share with you what those changes were, and we're also going to cover interest rates, the Fed potentially lowering interest rates, how that impacts your investments, some actions you might want to take in order to take advantage of the current high rates before the Fed starts cutting these rates. Also, we want to talk about the buffered index portfolios, what we're seeing as far as the new cap rates. And also, we got the 5-year beating the S&P 500 product back. I don't know for how long, but it is available now. And so we're going to talk about what the numbers look like on that. I know a lot of you have been asking about it, so we're going to share those numbers with you. So let's get started. So the big news was the jobs revision numbers. We now have seen 911,000 jobs that were previously reported to have existed do not exist. They are fake numbers. The government has revised their numbers by 911,000. This is a massive revision. This is the biggest revision that's ever happened in the history of the jobs data. And so this is a very, very big deal. There was another big revision last year of 880,000. So clearly these people don't know what they're doing as far as coming up with the jobs numbers. I mentioned this in previous updates, how I thought these numbers were not accurate. And so it turns out they are not accurate at all. And what we've seen now is the response from a lot of economists. The chief economist for Bloomberg has now come out and said he thinks that a recession started in April of 2024. So it just wasn't something that anyone admitted. So it looks like now the data is showing that we have been in a recession. We're seeing it in a lot of the economic data. And of course, I said many times, in fact, a year in advance, that I thought the recession would probably start in June of 2024. And I was surprised it hasn't happened. We talked about it in previous market updates. And it turns out that June of 2024 may have been a very, very close call as far as when a recession may have already started. So looking at these jobs numbers, looking at this data, it's definitely a concern, and now we have to understand what's going to happen with the Federal Reserve meeting that is coming up next week. If you look at the markets and the analysts and what they think is going to happen with the Fed next week, it's about a 99% probability that the Fed cuts rates on September the 17th in the next meeting. And so we will probably see a big impact from the markets. The real question is it going to be 25 basis points or is it going to be 50 basis points? And of course, last year, the Fed, right before the election, slashed interest rates by 50 basis points. It was a big deal. A lot of people thought that was a political move on the Fed's part. But it looks like based on these numbers, there's no question they're going to do at least 50 because the current economic data is so bad. However, maybe they will just do 25. Put what you think. If you want in the comments below, take a put down there what you think. Is it 25? Is it 50? We'll see what happens on September 17th. But either way, interest rates are going down. And if that happens, it's going to be inflationary. So you're going to see most likely gold prices go up. You're going to see a lot of energy prices, things that are affected by these interest rates coming down will most likely be good investments. And of course, we're positioned very, very well for this. And then of course, the other thing we want to take a look at is what happens to fixed interest rates, maybe the shorter duration stuff. And this really impacts all of our clients that are interested in that MYGA, that multi-year guarantee annuity. Currently, we have a rate held at 5.75%. Great interest rate, and so that's on the 3-year and the 5-year. That's the best one we have with a high quality insurance company. And so 5.75% in the event you want a 10% access on this account during the 3 years or 5-year term, it does lower the interest rate to 5.6%. And that gives you access to 10% of your money every year during the term. And so now might be a really good time if you're interested in potentially doing this. Now's the time to jump into this because we don't know what happens. All bets are off after September 17th. There is a high likelihood that interest rates are coming down, and once they start to come down, they often take a long time before they come back up. So now may be a time to lock in these rates, and maybe even consider the 5-year lock, depending on what your needs are and what your liquidity needs are. At least you're locking in that 5.75 for a full 5 years, because based on this recessionary data and the economic data, the jobs revisions, what we're seeing is that we may be in for a little bit of a longer time frame with lower interest rates. So the next thing I want to cover is the buffered index portfolios. These are our favorite investments. They perform so well for us. And when you look at the actual investment, we've gotten returns that are very comparable to market returns with these big insurance policies protecting the account. And the fee structure on the ones we do is pretty darn low. It comes out to 1.55%. So 1% is the advisor fee that we collect, and then there's a 0.55 fee on the actual note. And these investments, they're really, really good because you get to participate with the S&P 500 on the market going up. And if the market goes down, not only do you not lose money, if the market starts going down, you can make the inverse return. And so these particular products have worked very, very well for our clients. And the new one that we have available on the 2-year is a 16.8% cap. Now this is quite a bit less than the previous caps that we've seen in the past at 20% or 22%, even the most recent one at 18. The 16.8 is a bit disappointing in the cap. And the reason is because people are concerned about the market coming down, the overvaluation, and we could potentially lower the insurance to keep those caps up in the 20% range, but I don't think that's a good idea. I think you want that 20% dual directional insurance policy because we're trading at such a high multiple in the market. You look at PE ratios, CAPE ratios, market cap to GDP, it says it's expensive, so you want that protection. And in the event the market starts going down, not only do you not lose, you make the opposite return all the way down to negative 20. So if the market's down 12%, you're up 12%. If the market's down 19%, you're up 19%. It's a really big deal. And if the market goes down more than 20%, you just get a 20% reimbursement. On a 2-year basis, that's a very rare occurrence, but even if it did, it went down, say 25%, you'd get reimbursed 20, you'd only be down 5%. So this is a good way to participate with some upside. And when you think about a 16.8% return, that's 8.4% per year. That's probably going to meet all of our retirement goals. And that's what we're trying to do, is we're trying to meet our retirement goals. People sometimes say, I want to beat the S&P 500. I want to, outperform. And we can do that, but for these particular products, what we're trying to do is protect principal. We're trying to hedge risk. We're trying to make people's retirement accounts work without any problems. And if you say, I just want to beat the S&P 500, well, I got great news. I know a lot of people have been asking for this. We've had all kinds of calls. I know some people felt like they got left out because the product disappeared. We just couldn't get it. In the last month, it was not available. The pricing wasn't there, but we worked very, very hard, and we were able to secure a new 5-year barrier index, and this is one that's really good. We actually are going to get 176% participation on the S&P 500 Futures Index. Really, really nice. So it's going to go from October of 2025, and it's going to go all the way to October of 2030. Whatever the S&P 500 does during that time, you're going to get 176% of the performance. Not quite as good as the 190 and 195 we saw on the previous ones that I was screaming from the rooftops, you got to get into this. But 176 is still very, very good. When you think about the math, if the market's up 50% in the next 5 years, you're going to be up 88%. If the market's up 100% in the next 5 years, you're going to be up 176%. So I really, really like this product for people that want to outperform the stock market. And I am concerned in the short term. Over the next year, 2 years, I don't like the economic data. I want the protections in place. But 5 years from now, with inflation, I think you're going to see a much, much higher stock market. Obviously, it's not guaranteed, but the chances are very, very high. And this product actually has a 50% barrier. And that means if the stock market is down in the next 5 years, as long as it's not down more than 50%, you're actually going to get a return of your principal. So there's actually some protection on this account, even though you're outperforming the S&P 500 index. So very, very good product. The deadline, and these are hard deadlines, you have to have the funds in and in the investment by October the 7th. So it's pretty important. We probably want to have any funds that are being transferred into Schwab, we want to have those in by the end of the month so we can make it all happen and get it into the investment. If it's money that's already at Charles Schwab, we're probably going to want to be a couple days ahead of time just to make sure we're in place. But October 7th is the hard deadline on those buffered indexes. And so now's the time to really buckle down and look at these investments. Obviously, we're working really hard to review all of our client accounts and see where there might be some opportunities. In the event you're interested in any of these products, taking advantage of that 5.75 while you still can, reach out to us. And keep in mind, you don't have to ask for me. There's other advisors here in the office that can help you. So if I'm not available for any reason, I know I'm going back to a conference next week where we're going to look at a lot of new investment products and hear some good speakers on the economy. So I'm going to be back in Minneapolis and Minnesota at that conference. So if for some reason I'm not available, just ask for one of the other advisors. They can help you with these products. We can make sure that you get in before these deadlines. And remember, the 5.75%, there's no date that that's going to be reduced. Could stay up for a long time, but the Fed is probably going to lower interest rates on September 17th. And when that happens, there is a high likelihood you're going to see some of those rates start to come down. And then, of course, the buffered index, October 7th is our funding deadline for that. So I hope that was a good mid-month market update and you got something out of it. Feel free to reach out if you have any questions. Very happy to chat with you. You can obviously get us on support at copleyfg.com. This is a great email to use. It goes to a whole team here. You typically get very, very fast response rates from us if you use that support at copleyfg.com. And we look forward, if you do come into the office, look forward to seeing you in our Mission Valley office very, very soon.